Now I think we're in more or less a normal silver market. What do I mean by that? What I just said a moment ago, we're in where we've got a struggle between the physical and the paper paradigm. And that's kind of where we've been for most of my life. So we're back into that. So we're going to consolidate, probably go sideways. My thoughts are we're going to go sideways through the summer. The metals have a seasonality that they're weak in August, weakest in August. Doesn't hold every year, but it's a good rule of thumb. So I think there's a little bit of patience required for current, holders of silver or new purchases of silver. But it doesn't mean the bull market's over.
Only my only thought is you have arbitrageurs who know that they can sell it silver for 70, but they're not positive that they're going to get delivered on. So are you going to take the chance where you're buying silver at 75, but you can't get it to deliver to your sale at 85? Do you really want to be making silver?
The silver market is entering a phase that looks familiar on the surface but carries deeper structural tension. What appears to be calm is actually a reset, where competing forces are quietly building pressure again. David Morgan and Bill Holter explain that silver is once again catch in the long-standing battle between physical demand and paper pricing. According to their view, this is not a breakdown of the bull market, it's a consolidation phase. Prices may drift sideways through the summer, following historical seasonality in which metals often weaken, especially in August. But beneath the calm, something is more important is happening. Physical buyers continue to accumulate while paper market still attempt to dictate short-term price direction. That divergence has defined silver for decades and it's now re-emerging in a more visible way. The key takeaway is patience. This phase is not signaling weakness, it's signaling preparation. If the physical side continues to tighten while paper pressure remains artificial and the imbalance could eventually resolve sharply. This is where smart money waits not exist. Now, we present the clips from their interview. Before we discuss this, please hit the like button, subscribe to the channel and hit the bell icon. Thank you and enjoy the video.
And it's out there, especially in, it's in print. So I can't go back on something in writing. I mean, I was getting very worried in January. I mean, we went up 140% for the whole year in 2025, which is magnificent. Very happy in my own account. And then in January alone, it went up 70%. So I had already anticipated a parabolic move, put out for my paid people how to filter out into strength because you want to sell in and leave something for the next guy so you can get full price. And I put on alert that you could sell into the $100 rally, partial profits. I never recommended everybody to take full profits. Of course, it's always their choice. So it was overdone. And now I think we're in more or less a normal silver market. What do I mean by that? What I just said a moment ago, we're in where we've got a struggle between the physical and the paper paradigm. And that's kind of where we've been for most of my life. So we're back into that. So we're going to consolidate, probably go sideways. My thoughts are we're going to go sideways through the summer. The metals have a seasonality that they're weak in August, weakest in August. Doesn't hold every year, but it's a good rule of thumb. So I think there's a little bit of patience required for current, holders of silver or new purchases of silver. But it doesn't mean the bull market's over. There was an article, I'll say it because, I get a lot of information and a lot of it's from the banks. And of course, the banks have a different viewpoint than I have. But nonetheless, Bloomberg put out an article from one of their chief technical guys saying it's over, that parabolic move in January was the end, and that silver is going to trade down to 50 and perhaps as low as 34. I'll go on record on your show, Danny, saying I don't agree with that. I still think the bull market's intact. And I think we have some work to do to get back to the $100 level. And I'll say it here again that when we hit 100 again, I do think there will be retail selling because when we hit 50, a lot of people that have been holding silver for a long time thought that was it. 50's it. It'll never go any higher. And we did stall out at 50 for very few trading days. It didn't take long, but it finally worked through 50. And as Bill said, he went from 50 to 120. He had a $70 move above the all-time high in record time outside of the last couple of weeks during the hunt situation. So still bullish, still think we're going higher, but I also am a realist. I think we've got to be patient and let the market work through what it can, because there is a point where, as we continue to say, physical dominance will control the price of silver. We're just not there yet. Well, I think there's some nuances to this story. So let's break it down in the real basics. I mean, what is the real source of silver supply? 850 million ounces per year is mined. 150 million ounces is recycled. So you have 1 billion ounces. So where's the COMEX fit into this? And of course, when we're talking silver, I want to distinguish between the silver market, which I define as 1,000-ounce bars, and the retail silver market, which is it's very important. But that's not where the price is determined. The price is determined in the derivatives markets, 1,000-ounce bars to back it up, not silver eagles, not silver maples. So the COMEX is very small in physical terms. Historically, less than 1% of the futures contracts actually go out for delivery. Almost all are rolled forward, closed for cash, or even when delivery occurs, it's often warehouse warrant transfer. The metal doesn't move. The COMEX contribution to the real world physical supply is well under 5%. It's often misleading because much of the bank-to-bank reshuffling is not new supply. It's just moving the owners of that pile of silver back and forth, and it's happened for years. The LBMA, that's a little bit of a different story. It's the largest physical silver market in the world, and it's an over-the-counter market, and that's where clearing and settlement takes place. The banks hold about 27,000 tons, which is 870 million ounces, much as that's in the ETFs, as most silver investors know. It is the biggest marketplace for silver, but the nuance is it doesn't produce any silver, and it's a clearing, allocating, and redistribution center of existing metals. So the basic thing is 95% of the silver goes from the refineries into the fabricators, the industrial users, the people that use it for paste, solar panels, et cetera, and investors, because those 1,000-ounce bars do get broken down into coins, medallions, 1-ounce wafers, 10-ounce wafers, kilo bars to 100-ounce bars. So I think the main thing is that, as I think we all know, COMEX is for futures hedging. It's a paper game. It obviously controls the price and has for years. The LBMA does clear, but it's mostly vault transfers. Some does come out. We know that. And most of this metal on these deliveries is reallocated, not moved.
David's absolutely correct. COMEX was never intended to be a delivery market. And he's right, 1% or thereabouts going the last 18 months. The deliveries have increased and continue to increase. Matter of fact, over the last 18 months, whatever stood for delivery on first notice day, by the end of the month, there would be more standing for delivery at the end of the month. That's been going on for the last, like I said, at least 18 months, up until March. This March, after a month where 40 million was delivered in January, 25 million in February, and we had 52 million standing at the beginning of the month with a inventory of, I think it was 73 million at the time. By the end of the month, it was down to 40 million. That was the first month in 18 months where there was less standing for delivery at the end of the month than at the beginning of the month. We also saw something, and I think we've seen it 3 times now. The CME itself stood for delivery, not for a huge amount of contracts, but I've never seen CME stand for delivery. Now they've done it 3 times. So it's become different than what it was up until 18 months ago. I think we were starting to see the beginnings of price discovery. I think anything under $150 it's still suppressed price discovery. What you saw, what you heard the end of last year, early this year, was the supply and demand deficit, the structural deficit that's been in place now for over 5 years. The big talk was there's been so many new uses for silver that's increasing the demand, the solar, green energy, etc. And you just barely started to hear about AI. AI will not work without silver, and lots of it.
What stands out in this phase is the role of arbitrage and delivery related uncertainty. Market participants may sell silver on paper markets, but there is a growing hesitation beneath the surface because confidence in actual delivery is not absolute. That is critical shift. When traders are unsure whether they can convert paper positions into physical metal, it introduces risk into the system, and over time, the risk changes behavior. It reduces aggressive selling and increases the importance of real supply. At the same time, the seasonal weakness provides cover. Prices moving sideways and slightly lower create the illusion of a quiet market, but structurally, stress can still be building. This is often how major moves begin, not with headlines but with slow and quiet imbalances. The expectations here is not immediate upside, but rather continued consolidation before a stronger directional move emerges. Now, let's get back to the interview.
I have done swaps when the gold silver ratio gets out of whack. I traded palladium for silver probably at almost exactly perfect time when we were in April and gold had made big moves and silver and platinum were just sitting doing nothing. In my paid report, I said, don't buy gold, wait, it's going to level out at 3,500 through the summer, which it did, and buy silver or platinum. And as soon as the ink dried on that report, platinum and silver both took off. So, and also just to back Bill up, I mean, look, I believe in the free market, and if you stack silver for X amount of time, and you want something or you got a goal, it's your money. I just finished the silver $100 silver party in Las Vegas for my members. It was a wonderful event. One guy came up with almost tears in his eyes. I'm exaggerating slightly, and showed me the boat he bought. His life dream was to own that boat, not to own a bunch of blocks of silver till he died. And I was happy for him. So in that case, the guy lived his dream, right? And silver helped him achieve it. So I'm not saying sell your silver. I'm just saying it's a case by case basis in my view. But to back Bill up, I mean, the one thing I said when I was telling my people they wanted to take partial profits, go ahead. I think we're going to stall out in the 100+ range, but don't sell it all no matter what, because as Bill says, the last thing you want in the world is for a true hyperinflation or a complete currency collapse, and you're there holding currency. I mean, you do not want that. We own silver for a very specific reason, and that's to hedge against that kind of a default. We talk about a default on a COMEX, which would be very critical to the whole financial system. But a bank failure, I mean, that's even bigger. So anyway, no, I think Bill's right. I think there's a part. But again, if you've got something you want, do it. This guy couldn't have been happier. And he was not a young chicken, but he's got enough years left to probably live on that boat and, have a smile on his face every day. Well, first of all, my favorite saying is the market knows more than anyone. And I see it going sideways through the summer, building a base around 75 to 85 maybe. Once we get above that, we'll start to move up. And then once we move up, it certainly could go parabolic again. The reason I'm pretty convinced we didn't see the top is that retail basically put their hands in their pockets and didn't buy.
Right.
And what we're seeing, I think one of Andy's latest interviews is about, the industrial side. The industrial side has become more important in the silver market of late. I mean, 65% of the market's based on industrial demand. That's not going away and is probably increasing. Solar may be taking a slight hit, and even no one really knows that. But as Bill said, with electric vehicles, AI, and no one talks about the amount of silver in a robot. There's robotics that's also coming in vogue. So there's a lot of demand coming. Jewelry doesn't really vary in the silver market very much. And then silverware is a non sequitur. It's about 4% of the market. So the edge of the market is demand from investment. And if we have investment coming in from not from institutional, which we will see more and more, we've got a bigger demand. We got the critical mineral. So the U.S. government will probably stockpile silver at some point. 401ks are now eligible to include gold and silver in their choices for their employees. And then you have just smart people that run hedge funds that say, wait a minute, gold looks great. Why not diversify into silver? And it's easy for them to do it in the ETF market. Not that I'm favorable to the ETF market, but it does put a demand on the metal. not the same as physical delivery, but nonetheless, it still counts as demand. So I think there's a lot of upside left. And when I see the retail market come in strong in a parabolic move, that will be telling me that you want to be careful. And again, do you want to sell for paper or not? We've already had that discussion. So gold is a leader and gold is more establishment. The banks keep buying it. The banks know what's happening. And I'm sure in their darker moments, they probably don't sleep well at night thinking there could be a banking crisis, a banking failure, some type of money center bank that goes down, failure to arbitrage between the yen trade and the interest rate swaps. Remember, this quadrillion or so in derivatives, almost all of that is interest rate bets. And not everyone can cover their bet. It's all equal. There's the same amount of, long and shorts and all that nonsense. The point is that thing is so overextended that there will be failures and there will be people that are not able to make good on their bet because they lost it. They don't have the cash to do it. So there's a lot out there. And it mostly revolves around, as I said earlier, the debt market or the U.S. Treasury market and bets on interest rates. And we've got a lot of problems out there in that sector because it's supposedly the safest part of the market you can be in. And the truth is, it's probably the least safe place you can be.
Right.
Mr. Gold, what's your view on gold?
Well, gold is money. And why are central banks buying so much gold? Because they understand that gold is real money. Everything else is credit. Their paper's credit. US dollars are credit. What David just talked about with the derivatives, just to put that into just plain English, it's a zero-sum game. There's going to be winners, there's going to be losers. The problem is the losers, when they lose so big that it bankrupts them, then the winners become losers because they don't get paid. It takes everything down. So while you are waiting for the system to come down, where do you park your money? You park your money in money that cannot bankrupt. There's only two monies that can't bankrupt. That's gold and silver. I think you're going to see silver outperform gold simply because of the ratio. I don't know what number it's going to get down to. Does it get down to 40, 30, 20? I don't know. And nobody knows. Well, once there's a break in the derivatives market, you're going to have a permanent plateau. You're not going to see a 1980s event. You're not going to see a 2011, 2012 event. You're not going to see gold and silver go parabolic and then all of a sudden start to evaporate again. And the reason being, where would you in a system that breaks, where are you going to put quote profits from gold and silver? Where do you hold those that are safe? The answer is gold and silver themselves.
Stepping back, the bigger picture becomes clearer. Silver is not behaving like a typical commodity. It's acting like a market under constraint. The repeated tension between paper supply and physical demand suggests that the price is not fully reflecting the underlying condition. If this dynamic continues, the long-term implications are significant. Periods of sideways movement often precede expansion phases, especially when fundamentals remain intact. The current patience phase could be laying the groundwork for the stronger breakout once seasonal weaknesses fades and demand reasserts itself. Historically, when silver exists these consolidation zones, the moves tends to be fast and aggressive. What makes this setup more compelling is the underlying doubt in the system, specifically around delivery and true availability. If that doubt grows, it does not just impact pricing, it impacts trust. And once trust begins to erode in paper markets, capital tends to move towards physical ownership. That shift, even if gradual at first, can create powerful upside pressure. So while short-term movement may look uneventful, the structure tells a different story. This is a market coiling, not collapsing. Share your thoughts about this interview in the comment section below. If you like this video helpful, please hit the like button, subscribe to this channel and ring the bell icon. Thanks for watching.